So imagine staring at a stock that has, skyrocketed over 2,600% in just a single 12-month window.
Yeah, that's the kind of chart that makes you do a double take.
Exactly. I mean, the news cycle right now is overwhelmingly bullish. The analyst ratings are this absolute sea of green screaming strong buy, and the whole narrative around AI demand seems, well, pretty unbreakable.
Right. It looks like the perfect institutional darling on the surface.
But then you actually run the numbers, you look under the hood and the math starts flashing some very serious warning signs. We're talking massive net losses here.
Huge net losses, yeah. Plus some incredibly stretched valuation multiples.
Yeah, and quiet whispers across trading desks of a classic value trap. Worst of all, the order flow is starting to look like the smart money is already heading for the exits.
Which is exactly why this is so critical right now.
So the big question for you guys listening is this. Is SanDisk Corp ticker symbol SNDK still a generational buy, or are retail traders currently being lured into providing exit liquidity for a falling trend?
It's arguably the most fascinating market paradox we're seeing right now.
Totally.
You have this unstoppable AI supercycle narrative colliding head-on with some brutally heavy fundamental realities and really erratic tape.
Right.
It forces you to ask whether the market is pricing in a totally new paradigm or if we're just watching late-stage momentum kind of run on fumes.
And we are going to dig right into that paradox today. Welcome to the deep dive, everyone. We are looking at the landscape as of today, April 10th, 2026, to separate the hype from the actual financial reality of SanDisk.
There's a lot to unpack.
There really is. And while we break down the tape, we want you to drop your own theories in the comments. Let us know if you are buying this rally or if you think the top is in. It's compulsory. We want to hear what you think. Also, please like the video and subscribe to our YouTube channel.
And just a quick reminder before we jump into the data, this deep dive is strictly for educational purposes. We're analyzing trends here, not giving financial advice.
Exactly. Your portfolio is your responsibility. So to really understand the sheer scale of the situation with SanDisk, we can't just look at today's price.
No, you have to contextualize the structural shift that happened last year.
Right. The Western Digital spinoff, that was the primary catalyst in early 2025.
Yeah. It essentially untethered SanDisk.
It did. It allowed them to become a pure-play operation just in time to catch the wave of the AI infrastructure build-out. Suddenly, they weren't just a consumer storage company anymore.
Right. They were positioned as the critical memory backbone for these massive AI data centers.
Exactly. I mean, we all know GPUs get the glory, but those processors are literally useless if they can't access massive, incredibly fast data storage.
And that's the core of the bull thesis right there. The shift from inference to training models in AI requires astronomical amounts of fast access storage.
Yep.
SanDisk's NAND flash memory infrastructure is crucial for that. The market recognized that untethered potential almost immediately post-spinoff, but, the magnitude of the re-rating is still just breathtaking.
Breathtaking is the right word. Let's frame the actual price action for you. So, in April of 2025, SanDisk hit a 52-week low of $28.27.
Okay.
As of today, it printed a new 52-week high of $873.95, and it's currently trading right around $851.77.
That is just wow.
Yeah, that is a 2,640% rally. If you manage to capture that from the bottom, a $10,000 position turned into over $250,000.
Which is life-changing money. But when you have that level of capital appreciation in such a compressed time frame, the market psychology entirely shifts.
How so?
Well, it stops being about fundamental valuation and becomes a pure momentum trade driven by FOMO, fear of missing out.
Right.
But the underlying business metrics simply cannot keep pace with the stock chart that essentially goes vertical.
And that's where the financials get deeper contradictory. Okay, let's unpack this. Because looking at the trailing 12 months, they are pulling in massive top-line numbers. Like, revenue is sitting at $8.93 billion.
Which sounds phenomenal.
It does. But when you look at the bottom line, it's a completely different story. They're reporting a net loss of $1.04 billion.
Yeah.
With an EPS, earnings per share, floating between negative $7.50 and negative $8.07. This feels like a restaurant with a line around the block, bringing in billions in sales, but somehow still losing $1 billion a year on the bottom line. How is that possible?
Well, the disparity between that top-line growth and the bottom-line reality is severe, but, it's a known phenomenon in capital-intensive tech cycles.
Okay.
Analysts are projecting 92% revenue growth and up to 100% earnings growth for the coming year.
Wait, really? 100%?
Yeah, meaning the market is essentially pulling a decade of future cash flows into today's valuation.
It's just wild to see positive free cash flow of $1.25 billion alongside a billion-dollar net loss, though.
Right.
It tells me immediately that non-cash expenses, specifically aggressive stock-based compensation and the massive depreciation on those new fabrication plants, are heavily masking their actual cash generation. I mean, they are bleeding on paper, but the actual cash position is healthy at $1.54 billion, and the debt to equity is incredibly light at just under 8%.
The balance sheet is actually bulletproof.
Mm-hmm.
But your point on depreciation is critical here. Building a next-generation NAND fabrication facility costs billions of dollars upfront.
Yeah.
And accounting rules require them to depreciate those assets over time, which crushes their net income.
Yeah.
Add in the stock-based compensation you mentioned.
Which they need to retain top-tier silicon engineers.
Exactly. It's a highly competitive AI labor market. So you get this bizarre accounting artifact where the company is generating cash but officially losing $1 billion.
Which means if you are just running a basic stock screener, SanDisk looks like a disaster on a PE basis because there are no earnings.
Right.
But if you look at the cash flow, it looks like a juggernaut. It's no wonder the market is split. So if the spreadsheets are this messy, we have to rely on the tape, right?
Absolutely. How the stock is actually trading minute by minute gives us the real institutional footprint. What's fascinating here is that the tape is showing incredible strain underneath the surface.
Okay, break that down.
Well, the overarching trend is obviously bullish. It's trading well above the 200-day moving average. But momentum is not infinite.
Right. Looking at the daily RSI, the relative strength index, we're pinned at 68.29.
Yeah.
It's hovering right on the edge of traditional overbought territory. And there are very clearly defined battlegrounds on the chart right now.
Oh, for sure.
On the upside, we're seeing major resistance ceilings form at $872.05, $892.34, and then a massive psychological barrier at $910.73.
And on the flip side,
Conversely, if this momentum breaks, the support floors are situated at $833.38, $814.99, and $794.71. But honestly, the levels aren't what worries me.
what is it then?
It's the daily volume profile and the intraday price action.
Ah, you're referring to the distribution pattern.
Exactly.
It's a textbook signature of institutional offloading.
Yeah, the sources are flagging that prices are repeatedly being walked up in the pre-market on incredibly thin volume, only to face heavy, volatile selling pressure during regular market hours.
Right.
I liken this to a shady club promoter hyping up the VIP line outside before the doors open, only to sneak out the back door once the crowd actually rushes in.
That is a perfect analogy.
Yeah.
In the market, that hype is algorithmic.
Yeah.
A hedge fund holding 5 million shares cannot dump them into the market at 2:00 p.m. on a Tuesday.
Mm-hmm.
The slippage would be catastrophic.
They crash their own price.
Exactly. They would destroy their own alpha. They have to engineer their exits. By algorithmically holding the bid up pre-market, they create a synthetic gap up.
Right.
Retail traders wake up, they're driven by the AI narrative, and they see the green screen, so they buy the open.
Mm-mm.
And that retail wave provides the exact liquidity pool the institutions need.
To absorb their massive block sales without tanking the price.
You got it. The institution slowly feeds those buyers' shares throughout the day. It's a controlled demolition of their position, completely masked by the stock trading sideways or maybe slightly up.
That is so wild. And that institutional distribution pattern explains exactly why we are seeing such a bizarre disconnect in the analyst ratings right now.
Oh, the ratings are a whole different story.
Right. Wall Street is publicly screaming one thing, while the dark pools and order flows suggest they are doing another.
The analyst community is trapped in a structural bind here. If you look at the consensus, the vast majority of coverage on SanDisk maintains a strong buy or buy rating.
But the actual price targets they're issuing contradict the ratings completely.
Yeah, they do.
The average price target across the street is $825.05, but the stock is currently trading at $851.77.
Does make sense.
No. You have analysts slapping a strong buy on a stock while their own quantitative models dictate that it should go down. Now, granted, Bernstein has a street high target of $1,250, but you also have street lows sitting at $600. It is a massive spread.
That spread tells you everything you need to know about the difficulty of modeling terminal values for hardware during an AI supercycle. The analysts upgrading the stock to buy aren't necessarily doing it because their discounted cash flow models suddenly show a 2,000% increase in intrinsic value.
Why are they doing it then?
They are doing it to manage career risk.
Oh, interesting.
If a stock is up 2,640% and you have a sell rating on it, your clients are going to demand answers.
Right, you look foolish.
Exactly. So they upgrade the rating to match the momentum, but they keep the price targets conservative because they can't mathematically justify the current valuation multiples.
And the multiples are staggering. I mean, they are trading at a forward price-to-sales ratio of 14.1x.
It's incredibly high.
Paying $14 for every dollar of revenue for a hardware or manufacturing company is almost unheard of outside of, like, the software as a service bubble.
Yeah, hardware margins usually don't support that.
Right. And if you actually anchor this to current trailing metrics, ignoring the aggressive forward growth estimates, the bear case fair value models place SanDisk all the way down at $160.45.
Which highlights the absolute danger of the value trap here.
Yeah. I mean, if the fair value is $160, but it's trading at $850, aren't retail traders just catching a falling knife if the momentum stops?
Absolutely. If you are buying at $850 just because a prominent analyst has a strong buy rating, you might be in trouble. You're buying the rating, not the math.
Exactly.
The bull case requires absolute perfection. SanDisk doesn't just have to grow revenue by 92% this year. They have to maintain that massive growth trajectory for the next 5 years to justify a 14x sales multiple.
And any minor hiccup in supply chains or any slowdown in the aggressive capital expenditure from the big tech companies building these AI data centers.
Oh, that 14x multiple compresses instantly. Multiples contract much faster than they expand.
Yeah, they really do.
If the growth narrative cracks even slightly, the market will re-rate SanDisk from an AI darling back to a cyclical hardware manufacturer. And that is how you see a stock plummet from $850 down to the $400 range or lower in a matter of weeks.
Which makes the immediate roadmap so critical for you guys listening. We aren't just talking about abstract valuation theories. We have massive, concrete catalysts hitting the tape in a matter of days that will force the market to pick a direction.
Huge catalysts.
First, we have the Nasdaq-100 Index inclusion scheduled for April 20th, 2026. Then, just 10 days later, the Q3 earnings report drops on April 30.
The Nasdaq-100 inclusion is perhaps the most dangerous variable in this entire equation.
Because it operates as an automatic price-insensitive bid, right? Explain why that matters so much.
Well, hundreds of billions of dollars are tied to passive index funds and ETFs that track the Nasdaq-100.
Okay.
When SanDisk is officially added to the index on April 20th, the portfolio managers running those passive funds don't get to look at the 14x price-to-sales ratio or the RSI of 68 and decide to wait for a dip.
They just have to buy it.
Exactly. The algorithms mandate that they buy the stock on the rebalance date to match the new index weightings. It is the ultimate structural flow event.
Wow.
But if we connect this to the bigger picture, you have to view this through the lens of our earlier discussion about institutional distribution.
Oh, right.
If you are a massive active manager and you have been systematically offloading your position into the retail FOMO every morning, April 20th is your absolute dream scenario.
Because it's the ultimate exit liquidity.
Precisely.
You suddenly have a guaranteed forced buyer stepping into the market who has to absorb millions of shares, and they don't even care about the price. You can dump the final massive tranche of your position straight into the index funds.
And the immediate danger for retail traders is what happens on April 21st.
The day after.
Yeah. Once that mandatory index buying is complete, that massive structural bid vanishes overnight. The artificial floor holding the stock up is gone.
That is terrifying. And right as that floor vanishes, we get the Q3 earnings report on April 30th. This is where the rubber meets the road for the bull and bear cases. If the distribution pattern is real and the smart money has exited via the index inclusion, SanDisk better deliver a flawless earnings report.
They have to.
Because if they miss on that 92% growth expectation, or if their forward guidance suggests any softness in NAND flash demand, the worst-case scenario plays out rapidly.
Oh, for sure.
The momentum breaks completely, the institutions are already gone, and the retail traders who bought the all-time highs near $873 are trapped holding the bag in a vacuum of liquidity.
And a swift reversion to the mean in that scenario would be violent. We would see those support floors at $804 and $794 get tested and likely shatter, exposing the stock to a brutal momentum unwind.
Yeah.
However, we do have to look at the upside potential too, because shorting a stock in the middle of a supercycle is notoriously dangerous.
Absolutely. We have to be balanced here. The long-term outlook for the product itself is undeniably strong. There is an insatiable demand for next-generation storage. If SanDisk maintains its technological edge and pricing power, they have a legitimate path to growing into this valuation. So what does that look like?
Well, in the best-case scenario, the April 30th earnings report acts as a massive upside catalyst. They don't just meet the 92% revenue growth, they beat it.
Right.
They demonstrate that their capital expenditures are peaking and that they're utilizing their $1.5 billion in cash to rapidly offset those net accounting losses.
And if they do that, the market entirely stops caring about the trailing losses.
Exactly.
The narrative shifts from overvalued value trap to executing flawlessly, and the stock likely pushes right through those resistance ceilings at $892 and $910, making a real run toward that $1,250 Bernstein target.
The market is a discounting mechanism, and right now it is struggling to price a completely unprecedented technological shift. The tension between the bulls and the bears on SanDisk is so extreme because the variance in potential outcomes is so wide.
It really is the absolute duality of this company right now. I mean, on one hand, you have a cash-rich business pulling in nearly $9 billion, growing its top line by 92% thanks to an unstoppable AI wave, and proving its relevance in the most important technological race of the decade.
It's an amazing story.
But on the exact same token, it is simultaneously plagued by billion-dollar accounting losses, an aggressively steep valuation multiple, and order flow metrics that strongly suggest institutional players are quietly distributing their shares into the retail hype.
It is a phenomenal case study in why you cannot trade a single metric in a vacuum. The fundamentals, the technicals, and the macroeconomic narratives are all at war with each other on this specific ticker.
And as we always say, navigating that war requires you to question the data yourself. Look past the headline ratings, understand the mechanics of the order flow, and don't just blindly follow the momentum.
Exactly.
We want to thank you for joining us on this deep dive into SanDisk. Remember to leave your thoughts and theories in the comments and keep digging into the tape.
We've tracked this incredible run from $28 to $873 in just 12 short months. But as we head into these critical late April catalysts, here is the question you have to ask yourself.
Let's hear it.
When a stock is pushed to extreme historic highs right before a mandatory index inclusion event, are you truly buying into the ground floor of a new technological era, or are you just buying the exit ticket for the smart money?
Are you securing your position or providing the liquidity? Think about it. We'll see you next time.